All right, y'all, so in this video, I'm gonna bring y'all the no bullshit A to Z guide, whether you're a beginner, whether you already trade a little bit and you just not at the level you wanna be at, no matter where you are, these videos are gonna help you get to the next level, right? Now, I will say, these videos are a little bit older from my original blueprint. Y'all know I'm working on the blueprint 2.0 right now, which is obviously gonna be, more advanced, more in-depth, and just a lot more better, right? But for now, hey, like I said, these videos is gonna get you making profits. So watch it all the way through. And in the description, I'm gonna link my next video will be how to set up Tradelocker and how to get the broker and everything set up. So I'm gonna link that in the description. If anybody watching it now, just wait for tomorrow and I'm gonna post that. Let's get it. Welcome back everybody to lesson 2. So today we're gonna be going over setting up your Tradingview charts. So this is the Tradingview intro. And basically, I'm going to give you everything that I have on my Tradingview so you can almost replicate if you want to, or you can figure out what works best for you. So first things first, if you don't know about Tradingview, now you do. Go to tradingview.com. You can also download the app on your phone, iPad, etc. So once you get here, go ahead and open up any of the charts. It'll probably have like Apple or something already up there. But for my experienced traders, you already know how to go over this. So over here, I'm gonna click on settings. So I'm just gonna scroll through. Y'all see New York time. I'm just show you guys my settings so you can copy them if you want. Go ahead and pause whenever you need to. Most of this isn't really necessary, but feel me, gotta give you guys everything. So all of that right there is just basically for the appearance of how your charts look. Now for our technical aspect, first things first, you want to click over up in here and add a symbol. So first thing you want to upload is the DXY. So if you don't know why this is important, we will be going over this later, but following this blueprint that I'm providing, you definitely need to have the DXY on your Tradingview charts. And I put a little section right here. You can just right click, and to add a section, just right click. So under that section, we have US 30 right here. We have NAS right below it. And then we have SPX. So something that a lot of experienced, successful traders will tell you, and something that I've definitely learned over time, is that you want to limit the amount of pairs in different markets that you look at. So for me personally, I'm really only an indices trader. So like the index futures, US 30, NAS 100, and SPX 500. So those are the only pairs I'm really trading, or not really pairs, indices that I'm trading. And you want to look at the correlation and the divergence between them. If you don't know what that is, we'll go over that later. But basically, these 3 pairs should most of the time trade together. They should flow together because they're almost similarly the same thing. But if they don't, that could also give us a clue in the markets of what's about to happen next. So I don't trade all 3 of these at once, but I just kind of go over each market for the day and decide what's the highest probable outcome based on these 3. So I'm gonna just probably only take one of these per day, or if I'm trading for that day. I'm not really gonna trade all of them at once, but we wanna look at all of them at once just in case for some of the strategies we'll go over later. On top of the DXY, this is extremely important. And also lastly to mention, up in here, this is basically some of the tools that I've favorited. So if you wanna have like a little favorite bar, like how I do, I normally leave it like around here. It's kind of really not in the way. I put it right here. If you want to get that too, go ahead and favorite the same things that I have. So even if you don't know what these are, you can just go ahead and follow this just for later, so you'll be already ready and prepared. So first we want to start the Fibonacci retracement. We want to, where's the rectangle? See, I don't even know what this stuff is just because I have my, all right. So we want to favorite the rectangle, cool trend line right here. In the long position, horizontal ray, and then the short position. So that's really all you need. That's really all that I use. And if you don't know how to use that right now, we'll definitely be going over all of that throughout this course, so stay tuned. Welcome back to the Blueprint Academy. our day trading course. So for lesson 3 today, I'm going to be going over setting up a broker, basically logging into a trading account. So there's a few different routes that you can go about this, and that's basically what I want to touch up on and describe the differences between them. So the first account that most people will set up is a demo account with their broker. This is how I started. This is how a lot of people start, but you don't have to start this way. You can also start with a funded demo account. So I'm going to basically break down the differences. So, okay. So if you go to a regular broker like KOT or any of those brokers, basically you can either just put your money in and start trading that ASAP on a live account, or you can create a demo account. So basically you can put however much money you want. It's fake money that you're just going to be trading, but it's also real markets, real time, real everything. So it's basically just a way for you to practice your trading strategy, or just really get comfortable with clicking the buttons, clicking buy, clicking sell, you know, closing out your trades. Or if you've already made your profits for the week, you can stop trading on your regular account and just trade on demo just to keep your skills sharpened. So that's what a lot of people use demo accounts for. A live account is to just put money in and start trading and making profits, and you can withdraw anytime. Cool. Now for funded accounts, you can create a demo funded account with FTMO. But you can also go for the live funded account, which basically in the blueprint that I'm going to be providing is how you become a 6-figure trader in 2 weeks minimum. So with the live funded account, basically these prop firms will allow you to trade their money, and they'll just give you a profit split. So you can choose accounts from 10K, 20K, 50K, 100K, all the way up to like 300, 400,000, and you can start building multiple accounts and soon one day earn over 7 figures in equity to trade, and you'll just take a profit split. So now I want to go over basically the top 3 prop firms that I know are reliable and that most people will trade on, which would be FTMO. So with them and their challenge accounts, you would have to hit 10% on phase 1 and 5% on phase 2. So basically they'll give you a brand new account with $100,000 in it, and your goal is to make $10,000 on that account for phase 1, and then they'll reset you, and for phase 2 you have to make 5% on that account. Sounds pretty simple. It's just like making $10 on a $100 account or making $5. We can all do it. It's pretty simple. The only restrictions that I would say that they have behind it is that you have a 5% daily down draw max and a 10% overall down draw max. So if you go down 5% in one day, they'll take your account. You violated the rules. It's over. Or if you go down 10% overall on the account, you lose 10% overall, then you violated, they'll take your account. So you have to stay within those parameters. But once you pass phase 1 and phase 2, then the live account is yours. It's your 6-figure account. You can trade it. You can make profits on it every single month. And they'll give you a profit split anywhere between 75, 80 to 90%. So you'll keep most of the earnings that you make. And it's really, like I said, the key to becoming a 6-figure trader in 2023. Is really the best way. It's the new meta. So I just wanted to briefly touch into that. So really go over like the differences between demo and live, and how some people are trading over with their money, some people are trading with prop firm money, and basically just open you up to the possibilities. Welcome everybody back. Today's lesson, I'm going to be going over Forex Factory. Now, a lot of people will skip over this. A lot of people will let this go over their heads. But to me, and to a lot of the profitable, successful traders who've been in the game for a long time, we all know that this tool right here is extremely powerful. Now, it is free. Go to forexfactory.com. Definitely bookmark this on your Chrome browser, whatever you use, just like I have right here. And this is something that you're going to need every single day that you decide to trade. So any day that you're looking at the markets and you're considering clicking buy or clicking sell and getting into the markets, you must check this first. This is extremely important. It's honestly the worst mistake, one of the worst mistakes that you would want to make in trading. It's an extreme rookie mistake, I would consider. So basically what this is basically the news for Forex. So let's see. So here we go. So depending on what pairs that you trade, like I said, in this course, I'm going to be going over only indices. So US 30, NAS, and SPX. Those are my favorite pairs to trade, and that's all I'm going to go over because I don't want to confuse anyone. I want to keep this straight to the point, simple for everyone to learn, execute in the markets, and profit. So only thing I'll be going over is indices. For indices, we need to pay attention to USD. So as you see, it says yesterday, April 21st, we had a red folder at 9:45 a.m. And honestly, this part doesn't matter. It doesn't really matter what it is. I mean, it'll tell you like if someone is speaking, or this says flash manufacturing. And all of this really doesn't matter. All you need to pay attention to is the red folder and USD and the time. Those three things right there are very important. So for new beginner traders, I highly recommend to avoid trading anywhere between like a 10-15 minute span on any of these red folder news events. Why? Because you will see extremely volatile moves. You'll see price fly up 100 points and back down 150 points in seconds. And as a new, really a lot of experienced traders avoid these too. But especially as a new beginner trader, definitely avoid trading during these times. You can trade probably 15-20 minutes after and you'll be good. But just in between, like, if you're in a trade already at 9:35, 40, and you see this coming up soon, get out ASAP. Find a time to take your profits and be happy. If you want to look to get in about around 10 o'clock afterwards, that's cool. But for these news events, you definitely want to get out as soon as possible. Well, realistically, you should check before you even get into a trade so you can avoid getting into a terrible situation where you blow your account or hit your 5% daily down draw within a matter of seconds because you didn't notice that there was a news event. So like I said, this is extremely important. This is not something to let go over your head. And every single day that you're deciding to click a button in the markets, you must go over this and you must understand what you're getting into if you're going to try to trade throughout the news events. All right, welcome to the beginner technical series. So our first lesson today will be what is a pip, what is a point, and how to count them. So in this course here, we won't really be going over pips too much. I could show you guys how pips work just to show you, but realistically, like I said multiple times, we will only be trading indices. So we're only gonna have to worry about points. So let me show you these three examples of how points work within US 30, NAS, and SPX. So basically, before we get into that though, a point or a pip is basically what I like to consider a step for a human. So for me to get from point A to point B, I would have to take steps. If I get up from the couch and go grab my water, it took me 10 steps to get there, right? So that's basically what points and pips are in the markets. So like I said, we're only going to be looking at points. Let's go down to, let's say, the 5-minute candle right here on US 30. So let's look at this big drop right here. This big drop right here. So US 30 is an extremely volatile pair to trade. That's why experienced traders love to trade it, because you can make a ton of money very fast. So if you look here, if you take the ruler from here to here, it'll tell you basically, you can't really see because the thing's in the way, but let's just read price over here on the side. So this gray box starts at 33,831. So 33,831. And then it dropped all the way down to 33,670. So from 830 to 670. Look, I'm not here to teach math. Y'all should be able to count how many points that is, because I'm not sure. So let's go to another example. So that's extremely important for what we're going to talk about in the next lesson, I believe, which will be lot sizes and spreads. So you have to know how many points are being moved up and down to understand how to calculate your lot size. So if that doesn't make sense right now, it'll make sense later. Basically, risk management is the most important thing in trading, and there's nothing else to it. Risk management is the most important thing in trading. So you have to always be considering how many points you are risking in return for how many points you're trying to make. Your risk to reward ratio is extremely important. So if we look at NAS here, we can see, let's look at this move right here. And it tells us right here, price moved 17 points from 13,008 to 12,990. That's 17.69 points. So SPX right here, same thing. Let's look at this 5-minute bullish candle. Price went from 4131 to 4134, so moved up 3 points. So with SPX, it moves a little bit slower. NAS US 30 are basically almost the same speed, and that's important for a later topic. Unless you already know how indices work, then you already know. But that's all I wanted to go over for this lesson. What's a point, how to count them, and we'll explain why that's more important in the later lesson. Now in this next topic, I'm going to be going over how to read candlesticks. So this will definitely be important for the strategies I'm going to be showing you later. And basically just for your common trader's knowledge, you definitely have to know these things. So let's go over real quick. So as you can see, we're looking at SPX on the daily time frame here. And basically I'm just going to go over how the candlesticks work. So as you can see, this is a bullish candle. Price is going up, meaning bullish on this white candle right here. So if we're looking at it, I'm going to mark it out. This right here would be the open, because this is where price opened up at for the day. This is where price closed for the day. This is the high right here. And this is the low. So pretty self-explanatory. Might take some getting used to, but you'll understand very soon. So on a bullish candle, on a candle that's going up, we're always going to start right here. We're always going to start right here on a bullish candle, because we know that it had to start down here. If it was a candle that went up, we know it started below and went up higher. So it started here. This is the open. This is the high at the top of this wick. This is the low at the bottom of this wick, and this is the close. So basically price opened, it came down a little bit, and then it shot up, probably went up a little bit higher, retraced some, and then closed for the day. So this is, like I said, important for the strategies that we'll be going over later. And it's pretty self-explanatory at this point, pretty simple, and that's really all I have to say. All right, welcome back. So as you can see, we have the same example from the last lesson right up here. So I'm gonna go ahead, I'm gonna keep this up just for you guys to continue to see it. But basically, we're gonna be going over the wicks. Now, I did briefly go over it in the last lesson that I called this a wick. If you don't know what that is, now you know. So these little black lines above and below each candle are called wicks. And basically, so actually, let's go ahead and delete this. Let's go down to, let's say, the 5-minute candle frame. So this is kind of a support and resistance, similar perspective on wicks. That's not necessarily what I teach, but this is just an easy way to look at it. So right here, right here, right here, right here. We see, so you can see how price made a big wick up here, and then it started to fall, started to collapse, right? It came back up, and as you can see, it made all these wicks right here. All right, y'all, sorry about that. My camera died, but like I was going over, so these are the wicks. So as you can see, price tried to come up higher and it fought right back down. Next candle tried to come up higher by going all the way up here, and then it fought its way back down. Those are two wicks now. Same candle. Next one started here, went up, and it fought its way back down again. And then see price collapse, broke these lows over here, retraced, and as you can see, the same zone where it kept fighting back down, once again price flew up non-stop, going up, 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 up. As soon as it got back into this zone, you see these wicks right here, fought back down, came up, fought back down, came up, fought back down, came up, fought back down, and then flooded once again. So these wicks right here, these wicks are very important to note, and that's gonna basically help us understand what's probable to help happen next in the markets and how we want to basically analyze the markets and call our next trade. So those are basically how the wicks, that's how you look at wicks on candlesticks. And next we're going to be going into bullish and bearish order flow. All right, y'all, so welcome to the bullish order flow. So basically, when price is delivering higher in the markets, when price is going up, we call that bullish. And then when price is going down, we call that bearish. But there's a way that market likes to formulate its structure and how the flow goes. So basically, I'm going to be showing you basically the bullish order flow in this example on how, if the markets are trending up, what the bullish order flow would look like. So this is what a typical market would look like. We come up, we'd come down. We'd come up, slight retracement, come up again, we'd break structure right here, come right back down, go up again, come back down. So as you can see, I'm sure you're picking up on the trend here. Oh, I didn't mean to do that. But yeah, as you can see, this is basically bullish order flow. So we're gonna get into breaks of structures later, but price came up, retraced, and it broke this structure right here. As you see, it went above this high, broke structure, came back down, retested that same type of area, and they kept going. So this is normally what bullish order flow looks like. Quick example. Now let's jump into the actual markets. So I didn't really go hunting for any examples. I'm really just going to use the most recent thing that we saw here on Friday. So we could see basically how price started down here, retraced some. As you can see, that wick up in there in that area. If you paid attention to the wicks lesson, we came up, we broke our structure, came above this high. Basically, this is our break of structure. Then we retraced again, broke that structure again, came back up, retraced down again, and then went right back up before the close of the market. So it's not, most of the time, this is like a perfect example right here. So it won't always look perfect, but for the most part, the markets are always going to give you the same sort of similar things. So as you can see here, this is basically bullish order flow right here. And in the next lesson, we're going to be going over bearish order flow. All right, welcome back. So today we'll be going over bearish order flow in this lesson. So bearish order flow, like we saw in bullish order flow, it's going to be basically the exact same thing, just inverted. So price delivers lower, pulls back up for retracement, and then boom, floods down again, breaks this structure point right here. Most likely we'll pull back up into it, down again, pull back up some more, and collapse again. So it won't look this perfect. It could, but for the most part, it won't always look this perfect. So let's go ahead and show you a real life market example. So let's see what we have here. Let's see what we have here. So like I said, didn't really go hunting for the best example because I want to show you like a real market possibility. So I'm looking at NAS right now, which has not been downtrending too often lately. So I'm just going to use this quick example right here. So price started up higher, and then we see our retracement right here. After that, breaks back down, pulls right back up, breaks down again, pulls back up, breaks down, pulls back up, etc. So this is what bullish order flow would look like. Like I said, not the most picture perfect example, but this is just, you know, how the markets actually look. It's something that I wish people showed me when I was learning, because they show the lines and show perfection, but I couldn't really translate it to the markets too well. So I feel like that was a pretty good example of what a harsh market would show you as far as bearish order flow, because as you can see, just looking through the history, it's a lot of bullish momentum. Obviously we're looking at NAS, so normally overall expected to go up. So with that being said, this next subject is extremely important because we're going to be diving into the psychology of a trader. And honestly, psychology is 90% of trading, because at the end of the day, it's you versus you. Learning all this on the charts is honestly not hard. It just takes some repetition and training your eye. But overall, the thing that separates people from coming in here and losing money and quitting versus the people that end up being successful is psychology. So I definitely recommend you to stay locked in throughout this course, especially the psychology aspect. So like I mentioned before, psychology is definitely one of the most important things that are necessary to basically master to become a profitable trader. So basically, the best way for my strategy, like I said, I want to make this as simplified as I can for you and give you one thing to learn, one thing to focus on, one thing to execute, and master that. So in this segment, I'm really just going to go over how you should operate as a trader and the psychological aspect. So first things first, I did originally plan to give you a plan for live accounts as well as funded accounts. But honestly, like I said, I just want to give you one thing to focus on and one thing to master, and that's going to be live accounts. So to manage I'd say the best way to manage your psychology within trading is honestly to operate as a robot. Just be a bot. It sounds weird. It sounds dumb, but what I've learned in trading is that it's really you versus you every single day. Like if you make a plan and you follow it to the T and don't fight against yourself, you will succeed. So if you take what I'm telling you and do it exactly, if you do exactly what I'm telling you, you will succeed. It's you versus you. At the end of the day, I'm giving you the entire blueprint that you need to be successful. The only way that you will fail is by not following it. The only way that you will fail is not following your plan, is by not doing what you said you would do. That's really what all this comes down to. So like I said, that's why I say the best way is to operate like a robot. So what I mean by that is basically have zero emotions behind trading. When it comes to executing trades, you shouldn't have emotions behind it. When you're in the middle of a trade and you're thinking about exiting, you shouldn't have emotions. You shouldn't feel a certain way that then makes you do a certain thing. Your emotions should not result into actions. The only way you should take action is if your plan says to, if that makes sense. But to do what it takes to just simply, sorry about the thunderstorm right now, but to do exactly what it takes, that's what I'm going to give you. So I'm going to give you the shortcut. So basically the shortcut is to operate like a robot. So I'm going to give you this plan, and I promise you, if you follow it to a T, you will succeed. If you use this trading plan on top of the strategies that I teach, you will succeed. No doubt. I can almost fully guarantee it. So here's the plan. Let me go over my notes. So like I said, we're only going to be trading funded accounts. I'm going to give you a plan for this because I feel like trading a funded account is the quickest way to see success in trading. And as this is clearly titled, how to access $100,000 in 2 weeks. So yes, you do have the option. And what I do recommend is trading the prop firm accounts. And what I tell all my students is basically the lowest number to go for is 100K. If you don't have enough to invest into that yet, which is only 450, then I think you should just demo and stay down, practice until you feel confident to put that 450 in, get your 100K account. So now I'm going to show you how to get it in 2 weeks. Because as you guys know, you have to go through phase 1, go through phase 2, which takes 2 weeks minimum. And then you'll get your live account on week 3. So I'm going to go over that right now. Because it's a 5-day minimum trading for phase 1, 5-day minimum trading for phase 2. So it's essentially 2 weeks. So if you want to be conservative, there's 2 ways to go about: conservative or aggressive. Now for my new beginners, my people who've been trading for under 6 months, under a year, honestly, I would say probably go conservative, definitely. And what this means is you would risk 0.5% on every single trade, no matter what. You'll risk 0.5%, and you'll go for a 1-to-4 risk to reward ratio. So that means you'll risk half and you'll go for a 2% gain. Or you can risk 1% and go for a 1-to-2 and make 2% off of that. So like I said, risk 0.5% and go for a 1-to-4, or risk 1% and go for a 1-to-2. Now you're probably thinking, I would rather, don't think anything, just follow the plan. Trust me, follow the plan. If you're risking 0.5%, go for a 1-to-4. Set your TP, set your stop loss, accept your risk. Understand that when you enter the trade, accept it as if you already lost. If you're risking 0.5%, that's $500. Accept your risk immediately and understand that your profit target is 2%. So with that 1-to-4 risk to reward ratio, it will only take you 4 wins and you'll pass the account. You'll pass phase 1. Or you could risk 1% and go for a 1-to-2. Same thing, 4 trades. Now, for my little bit experienced traders, or for my people who, really go over this course multiple times, they really back test, they really just understand what I'm teaching and really go implement it and execute and really take this serious. If you feel confident, which studying makes you feel more confident. So if you've been studying a lot and you've been practicing a lot and you've been putting in the work and you've been doing everything you need to do, then you can use the aggressive model. So for the aggressive model, I'm going to say risk 1% and go for a 1-to-4 risk to reward. So you're risking 1 to go for 4%. Now, if you want to risk 2%, only go for a 1-to-2. So they both equal out to 4% gain. It's just about how you want to do it. Do you want to hold your trade a little bit longer but risk a little bit less? Or do you want to risk a little bit more and hold it for, TP2 and get out of there? So that's the plan. I'm going to have, the visuals up here for you to make it easier. Hopefully you're taking notes. I definitely highly recommend, if you haven't been taking notes, definitely pull out your notebook and pen now, because the next subject is strategies that we'll be going over. And this is obviously extremely important because you can't enter or exit a trade without having a strategy. Well, you can, but it's just not optimal, obviously. So like I said, conservative account,
risk 0.5%. If you go for a 1 to, well, if you risk 0.5%, go for a 1 to 4, which is 2% gain. Or risk 1% and go for a 1 to 2, which is also 2% gain. Now, if you have the aggressive, if you want to go aggressive, risk 1 for 4 or risk 2 for 1 to 2. Pretty simple. Now, the one golden rule that you always must follow, well, all of that I just gave you is what you must follow. Depending on what you choose, you have to choose. So if you want to go conservative or aggressive, that doesn't matter. Honestly, it's just about understanding your personality as a trader and understanding what you know you can maintain and manage, basically. So for someone who likes to scalp a little bit more and doesn't necessarily hold their trades as long as they should, go ahead and go for the 1 to 2 risk to reward setup. But if you know you would rather risk a little bit less so you can manage your emotions along with not having to worry too much, risk 0.5%, go for 1 to 4. That's cool, I promise. But the golden rule is whenever you reach a 1-to-1 risk to reward ratio, always set your stop loss at your entry. So what that means is if you're risking 0.5%, once you're up 0.5%, set your stop loss to entry. Once you're up floating in profits, the amount that you initially risked, set your stop loss to entry. If you're risking 1% and you're going for 4 on the aggressive model, once you're up that 1%, I know you're still going for 3 more, but set your stop loss at entry. This will guarantee you to never lose money if you took the right trade, if you had the right directional bias. Does that make sense? Whenever you're at a 1-to-1 risk to reward, always set your stop loss to entry. Anytime before that, accept your risk. Don't let it go up a few points in profit and then set your stop loss to entry and then you get tapped out and then you're upset when it still goes your way. Don't do that. Once you get to a 1-to-1, set your stop loss at entry and let your trade ride out. Now, if you ever want to take partials, by any means, take partials whenever you feel like it, honestly, because that all depends upon the trader. As long as you profit, everything is good with me. As long as you profit. But if you don't want to take any partials, you just want to follow a strict plan, I just gave you the plan. I promise you, you will succeed if you follow it to a T. Now, once you get your live account, so I just gave you the conservative and aggressive model for passing phase 1 and phase 2. Now, once you actually get your funded account, once you actually get the 6 figures in your possession, I highly, highly, highly recommend until you become a VIP member. So this is for my Forex funds. Until you get your first 3 months of withdrawals and you finally become a VIP member where you can withdraw any day, every day, then I highly, highly, highly recommend. There's no aggressive and conservative. We're only conservative once we get that live account. So we're risking 0.5% to go for a 1 to 2. Right? 0.5% to go for 1 to 2. So we're gaining 1% per trade, risking 0.5 to go for 1. You might not like the sound of this, but listen, I promise you, if you follow this, you will see long-term success. Any of those risking too much will just, trust me, don't do it. I don't even want to dive into that. Just don't do it. Just follow this plan. Either risk 0.5% to go for a 1 to 2, or like I said, this isn't necessarily aggressive to me. This is also still conservative. It's just if you really feel like you have an A+ setup, you can do this. So if you have the A+ setup, risk 0.5% twice and go for a 1 to 2 and a 1 to 4. So basically, you're going to enter twice at the same spot. Your first TP will be at a 1 to 2 risk. So you're risking 0.5% to go for 1. And you get taken out for profit, you're done. Your second entry is going to go for a 1 to 4. So you're risking 0.5% to go for 2. If the whole trade plays out, you make 3%. But overall, you were only risking 1. So that's all I have for the trading plan. Like I said, I promise if you follow it, you will succeed. Please, please, please just listen and follow it, and you'll be thanking me later.
All right, so in this lesson, I'm going to be showing you guys how to identify an order block. So basically what an order block is, it's sort of like supply and demand, but it's really more precise, a lot more precise. So let me give you guys a quick example. Let's say price is coming down. Bearish order flow coming down. All right. And then we, boom, come up. What we're going to be looking for basically is this last down candle, which will be this the last down candle right before the up move. Okay. The last down move right before the up move. Okay. It's basically that simple. I'm going to break it down simple to you. So let's see on the 15 minute. Let's see. All right. So right here, here's an example. Like I showed you, price trickling down, you know, going low, come back up, going back low. All right, and then coming back up, and then boom. So right here, we see price broke this low right here. It's basically like a fake out. So price faked like it was gonna keep going lower right here, and then exploded up. But what it left behind was this order block right here. So you can mark up the whole entire candle like this. Or to be more precise, you can mark up just that high and the body. Or even if you want to, you can do just body to body. It depends on what you're trading, what time, everything matters. So it depends on really how you like to get down with it. So you're definitely gonna have to look back into the pairs that you like to trade and understand how you want to go about it, because there's no necessarily not a wrong way. But for SPX 500, for the sake of this is valid right here. You know what I'm saying? We're gonna grab the high of this candle right here along with the body, because our risk wouldn't be any more than the bottom of this wick right here. So let's say we did take this trade example. We see this order block right here. After price came up, price broke this high right here, and then it retraced down perfectly right into this order block before proceeding to go right back up, flying into crazy profits. So let's just see, let's say we did take this trade example. Like I said, stops be around here or even at the bottom of this. We'd obviously be going, I wouldn't go for these entire highs right here just because I don't really care about the 1 to 11, but we could for sure trade back into this order block right here, see if that got smacked, and yeah, that did. So 1 to 9 example right here. Basically, this is how you identify an order block, and I'm going to be showing you guys later in the strategy section. Like I said, this is a brief example, but I'm going to be showing you more in depth on how to enter trades off of the order block. All right, everybody, welcome to the lesson. We're going to be going over the optimal trade entry, also known as the OTE. So first, let me pull out my fib. So this is the Fibonacci retracement. This is how we'll be finding the OTE, the optimal trade entry, from the Fibonacci. So it's really a fib retracement. If you don't know what that is, I'm about to show you now, but first we're going to tap into the settings here. So I turned off all the rest of these tickers, and all I have up here is 0, 50%, 62%, 70.5, and 79%. So go ahead and copy these down. These are extremely important. Go ahead and copy that down. You can change whatever colors or any of that you want, but I just keep it black. So let me show y'all an example real quick. So say price is coming down, and then it goes up here, pulls back right here to the 70%, and it takes off. Say that's how price prints. So we take our Fibonacci, and we would understand that the 70% is our optimal trade entry. So if we're eyeing the markets correctly, and if we're following our strategy correctly, then we should be able to get in. Now, sometimes you can get in at the 62% if you want to get in a little early and just have to risk a little bit more. Sometimes you could just, obviously this is the optimal trade entry for a reason. So the 70.5% right here is most optimal, but also sometimes it could pull back to the 79%, and that's still a valid trade. So obviously the lower it retraces, the less you will be risking, but the lower it retraces, the less probable it might be. Because if it pulled down 80+%, then it's probably not going to play out. But the 70% here, we would mark up a long entry, put our stops right at the bottom, and go for our most previous high. So you can see right here, that's basically how it looks. And now let's show you a real chart example. So as y'all can see right here, this was a cool London session that started around here. We made some London lows right here, as you can see, and then immediately just took off. So to me, I'm looking at this large impulse move as something that we definitely need to pay attention to, just considering that price has been trading lower, and then it all of a sudden just burst up here and broke this structure right here. So we broke this structure. So after coming down for so long, we exploded up, broke this structure right here. But this isn't the trade that we're looking to get into. This is just our sign of confirmation. Once we see this, then we understand that price was most likely trying to deliver higher. So we would take our fib from the bottom of this low to the top of this high. So say this is live markets. This is a 62% retracement. All right, so this is a 62% retracement. As you can see, came right back down into it, and then we took off and traded much higher. So let's look for another example so I can show you the optimal trade entry. Let's see this right here. Let's see this. So this is one that I actually traded not too long ago, a few days ago, like 2 weeks ago about. So let's see what happened here. Price snatched this liquidity down here, pulled up, perfect. So we're gonna go into the strategies a little bit deeper later, but for now, as you can see, we had a beautiful liquidity sweep down here, along with the large impulse move trading up. We pull our Fib retracement out, it taps right into our OTE, and then takes off for the no down draw buy. So this is a wonderful setup right here because it just follows almost everything. Like I said, we're going to be going into strategies more later, but you can see I showed you guys how to identify order blocks. So you can see right here, this is an order block. Price left an order block, and it made one of these OTE retracement moves. So that's how you know you can easily get in for a trade right here. Risk at the bottom of these lows, risking about 4 points, and just the most recent highs is already a 1 to 4 right there. So that's the example I'm gonna give you guys for the OTE. Make sure you copy the right Fibonacci percentages, copy my settings, and start applying this into your trading once we go over exactly how to use it in the strategy portion coming up next soon. All right, welcome everybody. So today we will be going over how to spot liquidity and use it to your advantage. So let me show you a quick example of what I see liquidity as. Let's say the price went up, came down, went up, came down, and then let's say it flies up here before completely tanking. Let's look at this example right here. So how I would spot liquidity is I like to look at it as like a pool of money. So as you can see, let me get rid of this. As you can see in this rectangle right here, so look at liquidity as where most people are getting in their trades in, right? So you can see price came up here. A lot of people probably got in, made some money on the sell. And then if they're still holding the trade, it might come up, tap back into their entry, and then more people are probably getting into this sell. So you got to look at this zone right here where a lot of people are getting in at, where there's a lot of money at, as liquidity. That's why it's, you know, it's basically like you got to find the money. That's how you got to look at it as. So that's how I spot liquidity. I just really look for where the money is. Now, what you can do to help you with this is take the money. I don't even know why don't know where my money. I don't know why my money sign isn't up here no more. I don't really use it like that just because I kind of did this in the beginning, not as much anymore. So what you can do is draw up liquidity and just put money up there, just so you know, just so you can always see that, and it's a clear visual. So basically, you got to look at it as the market's trying to take everyone's money. So this is a large pool of liquidity where everyone's making money at because it's going down. You know, they probably got back in, but they're probably all having a parade while it's going down. You got to understand that the markets will do things sometimes intentionally to take some money from you. So right here is an example. There's a large pool of liquidity, lots of people getting in for the sales. What Price is going to do is come in and snatch all that money. So it's basically just going to hit their stop losses and all that, and then make the move. So I know a lot of you who have a little bit of experience have definitely been in a position like this where you got into the trade and then it starts going your way a little bit, and I don't know where it spikes back up and then goes back your way. So this is exactly why. So let me show you a real life example. So here we could spot this right here. Consider this a pool of liquidity right here. Now let's look at what Price did. So Price came up, came down, people were probably in. Came up again, some people were probably still holding, up still. Now a lot of people are looking at this as, oh my God, this is probably a strong zone to sell at since it sold twice. So the third group got in right here and sold off. Again, they're probably all throwing a parade, making money, and probably trying to expect it to flood all the way down here. Realistically, what Price is going to do is come down, you know, trickle down a little bit. It's going to really trick them. Because as you can see, it's another pool of liquidity right around here. So that's all Price is going to do. You have to look at liquidity as like a target. Price looks at liquidity as targets. So wherever the market wants to go for the day, it's probably heading towards the liquidity. Or as you can see in an example like this, it can go both ways. So you see the liquidity here. Look, probably tons of people bought in right here. They're probably holding their trade out, and then somebody's probably looking at this zone as a strong zone to buy in, so they probably bought in right here too. Look, it goes up. They're probably making money, excited. What Price does is trap them. So you can see right here, this is the liquidity snatch right here. There's tons of money in here, lots of people making money right here. Price comes down, dips down into it, and then takes off, right? Takes off. What do we see up here though? Why did Price just spike up crazily like that? To snatch the liquidity. So this is all I'm going to go over for right now as far as just identifying liquidity and being able to just identify liquidity. As mentioned, everything that we're going over right now are just the concepts of what you should be looking for, and then in the next chapter we'll be showing you how to put it all together and really take trade ideas off of this. So like I said, I'm just showing you how to spot liquidity. It's basically large pools of money where you see a lot of wicks at and a lot of resistance or support, I would say, but we're not going to really use that to trade it within our plan. We're going to use it to let the markets snatch, and then we're going to, you know, get in and look for a move that makes sense. So you guys will see later in the later lessons. All right, so in this lesson I'll be showing you guys how to spot a fair value gap in the market. So let's get straight into the example. So normally, let's say we're gonna look for a bullish fair value gap. So let's say first Price is, say, trickling down. Oh, I swear there's another tool for this, but let's just keep going. All right, Price is trickling down. Hold on. Oh man, I'm messing up, y'all. All right, let's see. So Price, sorry. All right. So Price trickled down, and then let's say it just makes this large impulse move like this. So it's trickling all the way down, and then it makes a large impulse move here. Then say the next candle comes down to around here, and then takes off again. So what we're looking for is basically this area right here. So a lot of times we're gonna be looking for the fair value gap in the move right here. Okay, so we're looking for a large impulse move, and a lot of times that's breaking structure previously, and that's our fair value gap that we're looking to get in on. So let me show you a quick example. Let's go over. Look, I already can see one. So look right here. You got to train your eye to see this. You notice how, like, this isn't, I didn't pre-plan this right here. I just went to the NASDAQ, showed you guys an example. And as you can see already here, this is the first thing I'm seeing. So you got to pay attention to the wicks. So see the bottom of this candle. So I'm going to mark the gap between that and then the gap on this candle. So this bottom bearish candle right here gave us a wick that goes all the way up to here. And then this bullish candle, so you got to look at the candle before and after the impulse move, basically. So this is our impulse candle right here. This 5-minute candle right here, this is a large move to the upside. This is what we're looking at. We're looking at this small gap right there. So let's act like this didn't happen yet. All we're looking for is this gap. So I'm gonna get deeper into this in the strategy section, because right now in this portion, all I really wanted to show you is what a fair value gap is. So this is what a fair value gap is, but just to show you, as you can see, price broke this structure right here. Came back for 79 around OTE retracement, and as you can clearly see, that's an easy 1 to 3 right there to secure. Easy. So I'll go into the rest of that later, but I'm just showing you guys fair value gaps, how simple they are to identify, and how powerful they are to use within your trading. So let's see if I can look for another example real quick. Or you know what, let's just wrap it up with that, because later in the strategic category, we will be going over how to use fair value gaps to enter your trades. So let's jump into the next lesson. Okay, so in this lesson, we're going to be going over the power of the 50%. So this one right here, it has to do with the Fibonacci that I introduced to y'all in the other lesson. But this one can be used for a fair value gap, an order block, as well as a Fib retracement. So it'll make sense in a second if you don't understand, because I'm getting ready to show you right now. So as you saw in the Fib retracement settings, we added the 50%. So basically what I'm gonna do is right here is I'm gonna mark out here. Sorry, I rushed into it. So first I'll be looking at this order block right here. Say I had interest in this order block, right? Sometimes you don't always have to enter right at the bottom right here. Sometimes you can use the 50% level. So what this will do is give you a better entry, meaning you would be risking less. So you would have a higher risk to reward, but it might not always reach the 50%. Sometimes it can hit the bottom of the order block and then move on. But in a case like this, as you can see, let me see if I can stretch this out for you. Let me see. So I'm gonna mark up this order block from the low to the high right here. And then I'm gonna take this line and put it right on top of the 50% level. There we go. All right, and then I'm gonna delete all of this. I'm gonna delete the Fibonacci. Okay, cool. So say we were trying to enter a sell off of this order block right here. We wanted to use the 50% level. Look at the difference. So say we got in right here. put our stops, it wouldn't have to be that tight. Let's say if we put them right here for some 5 points above the candle wicks, and we're going for the low, you can see that's about a 4 restore right there, 1 to 4. But say we entered right here at the bottom of the order block and risked up here, that would really only be like a 3. So not too bad. It's just you can use this 50% level to get more precision in your trades within using, like I said, an order block like I showed you in this example here. Or say you marked up a fair value gap zone, you could use it for this as well. Just mark up the fair value gap from the low to the high with the Fibonacci, and line it up with your 50% level, as well as a retracement. So sometimes you may see price, let's say in bullish order flow, you know what I'm saying, if it was trending upwards, sometimes it could retrace down only to the 50% level and then keep going. So we look for our OTE, like I showed y'all in the previous lesson. We look for the optimal trade entry, but sometimes it could only hit 50%. Me personally, I don't take those type of trades, but depending on how your back testing looks when you go over these strategies, you may be accustomed to that yourself. So that's all I really have for this video. And yep. All right, so in this lesson here, I'm going to be showing you how to identify a break of structure in the markets. So say price is trending downwards, just like this. And then suddenly we get hit with this right here. This would be a break of structure, because normally, as you can see, we traded up, then down, and here was our market structure shift. So I'm gonna show you a market structure shift as well. So price traded up, came down, it broke through here, it broke through this low right here, but then it tapped back in and kept going. So this would be a market shift right here. Now this is the next shift in the market. Pushes down, comes back up, cool. Here's our next shift, pushes down, comes back up, but this time it broke this, it broke this high right here. So now coming up and breaking above this high is no longer in this downtrend like this. It came up and broke structure. So it's pretty simple, pretty self-explanatory when I show you that. So now we might start doing this. So market structure went from here, it shifted up here. So now we would expect this. Pretty simple. So let's show you over an example, which is right here. So as you can see, exactly like our example. Exactly like our example. Downtrend, come up one last time, and boom, we suddenly break that. And as you see, we take off for the crazy buys here. So normally when price breaks the structure right around here, normally you would expect a retracement, either back down here, or at least sometimes come down here and then go up most of the time. But as you see here, it just broke structure and just kept going. So that's all I really have to show you in this lesson. And next we're going to be moving into how to put all this together and turn them into strategies that you can use on a daily basis, every New York session almost, if you want to. So we'll go over that in a minute. All right, so in this lesson, I'm going to be showing you a beautiful example of the selling OTE model. So as you can see, price, it looks like price was making a bullish run. You know, we're in some nice bullish order flow, but this is how I'm looking at it. So let's mark up this liquidity right here. Notice how it got snatched. Notice how it got snatched just like that. Let's go ahead and, so our liquidity got snatched, and then we came down and broke this structure. And as you see, came up before we sold off again. A lot of people wouldn't consider getting into a sell right here, but we would, because we would take our fib from right here to here, from this high to this low, and boom. So you probably can't see it. Let me move these other lines. Move all that because you get the point now. So as you can see, our 70.5% right here is our OTE. So let's go ahead and clock in a short position right on that OTE. If you're willing to risk 30 points, that's cool. You could go for these lows right here, and that's a nice 2.5 risk to reward ratio. Or if you wanted to seek this low right here, or even this low, let's look at it. This low right here would have been 1 to 3. This low right here would have been a 1 to almost 4, 1 to 3.7. So we always have targets when we're getting into trades. We're looking at the nearest liquidity sweep that price could be making. So you see these lows here, these are important to note, especially one like this, where there's a triple tap right here. See the markets tap that line 3 times. So you know there's a lot of money there. You know a lot of people got in. You know, a lot of people are in right now, so you could expect price to at least come snatch this around here. 1 to 3 risk reward. That's pretty nice. That's all you need right there. So that's really all I got to show you for that. All right, so in this lesson, I'm going to be showing you the OTE buy model, the optimal trade entry on a buy model. So this is pretty simple. Like I said earlier in this course, I promise you, if you follow this to a T and only ever enter trades when you see exactly this, and you never risk too much, and you just follow the plan, you will succeed. It's really this simple right here, what I'm going to show you. So look, I'm going to have the what's it called? I'm gonna have the graph chart. Like I'm gonna have a picture up here for you guys to see to make everything, you know, pretty simple, pretty self-explanatory. And then on top of that, I will also be showing you this live chart example. So as you can see from the, what's it called? The picture that I have uploaded. We're downtrending. All right, and then here's our lowest low so far. We come back up. A little bit, and then here we go, boom. So we suddenly break our lowest low right here, right? It's really this simple. This is all you gotta look for. So look, we broke the lowest low, and then suddenly we also break structure right here. We break this high. So we broke the low and we broke the high in one move, right? All right, let's move all this so we can see. Okay, so let's take our fib now from the very bottom right here, and let's say price broke all these highs and traded to about up here. As you can see, this is our low. Since, you know, we were downtrending, we took out the lowest low, we also broke the high, and then we bought up for some time. We stayed patient. We marked the low, we marked the high, the fib, and as you can see, we tapped directly into the OTE right here, and that's when we can, boom, get in, risk to the bottom of this low right here, bottom of this candle right here, and move the fib at this point. Actually, no, I'm not gonna move the fib because that's the point of this video. And then we could have simply went right back for these highs right up in here. So this trade would have been a quick trade, a quick 1 to 6 risk to reward. So a lot of other strategies don't offer this. So this is really, really simple right here. I really can't make it any more simple than that. Normally price would continue to go up, but as you see, it went down basically the whole day, and we still ended up making money off of this buy model right here. So you can look for this almost every day. As long as you see everything in line, then it should play out. If not, you got to go back and back test and understand why it didn't play out, because you most likely need to train your eye to see it a little bit better. You probably didn't get the same exact setup that you thought you learned. So you got to go back and really understand everything, because this is an A1 setup right here, I believe, because obviously it's a 1 to 6 risk to reward, tight risk for a high reward. We have everything aligns, you know, we break the low, we come up, we break the high, and then we boom, retrace right into the OTE and completely turn around right after that. But one thing that they also left for us is this 5-minute order block right here, which aligns perfectly with the OTE. We've got an order block right here and an OTE retracement. It's perfect. So I'm not gonna make this too long. It's pretty simple. That's all you really need to know. All right, so for this, I'm gonna be showing you the bearish order block now. So this is how you can take a sell setup off of an order block. So as you can see right here, we're looking at NAS on the 15-minute. You see this order block right here that was created with a lot of volatility. You see price came up, it snatched the liquidity up here, and then it also broke the low right here. So that's when I would pull out my fib from the high to the low. As you see, we got a pretty nice 62 retracement right here, but we're not worried about the fib retracement right now. That's just another thing you can add in confluence with this bullish order block. So say we took a sell, say we took a short position right here off of this order block, and really just risk to the high of the body, because we wouldn't want to risk 90 points. At that point, it's not even really worth taking the trade. I would just risk right here above the candle. Cool, 34 points, not too bad on NAS. And we could be going for these lows right here. Always got to have a target when you're entering a trade. And these lows were definitely swept pretty easily with a 1 to almost 8 right there. So that's how you could enter a sell off of a bearish order block. Pretty simple, pretty sweet. All right, y'all. So in this lesson, I'm going to be going over the bullish order block and showing you how you can take buy setups off of this strategy and catch wonderful risk to reward ratio trades. So like I showed you guys, I mean, I just cleared that, you already saw it, but as I showed you guys in the previous video in the course, I showed you guys how to identify an order block. So now what I would say about this strategy is I would definitely highly suggest multiple things be in confluence, meaning multiple things all falling in line to tell you that the market will be buying, as far as everything else I've taught you in this lesson so far. So you would want to see, you know, OTE retracement with a market shift, market break of structure, this and that. Like, you want to see everything fall in line together that makes sense most of the time when you take a trade off of an order block. But the thing is about order blocks, you could honestly just take them just like this. I'm gonna show you. Like I said, it's better to have multiple things in confluence, but if you wanted to, you could simply just mark up an order block like this, and as you see, you can see exactly what happened. You would have got in on a buy right here. You could risk to the bottom of this candle, about 14 points. And you would have easily caught you potential 1 to almost 5 right here. 1 to 3 could have been gone, 1 to 4. That's a nice trade right there, off of simply just saying, okay, hey, this is an order block. Let me draw out a rectangle and let me enter off of it. Just that simple. And if you use what I taught you earlier, you could take your fib, mark it up just like that, and then mark up the 50% line right here. And you really could have entered off the 50% like this and risked. So yeah, there's the 1 to 5 right there. 1 to 6 potential. So it's that simple. That's how you can buy off of an order block. Like I said, multiple things in confluence do help, but as you see right here, it could be really just that simple. All right, so yeah, we got SPX here. Here's 10 to 11 marked out in red lines. So what we want to look for basically is price headed for liquidity on both sides. So let me break it down to you. Let's see, we have, this is 9, we have price trickling down, comes down. Okay, so 10 o'clock hits. At this moment, we have a clear, obvious liquidity above us, but we don't have one below yet. So we have to keep that in mind. So let's mark that out though. There's liquidity right here. Let's go ahead and mark that out. Throw some money signs in there. Liquidity right here. But okay, 10 o'clock hits and we go down a couple points and then we start going up. So now once we start going up, we can mark this as our downside liquidity. So like I said, during 10 a.m. and 11 a.m. every single day almost, we want to look for price headed towards both sides. We want to see price snatch liquidity on the upside and on the downside. So we have them marked out now. So it's 10:04, 10:05, 10:10. All right, so around 10:20, as you can see, price comes up and snatches liquidity right here, right? So here we go. We can X that out. Price liquidity has been snatched. We can X that out. Now we're going to zoom in real close. Okay. So once liquidity is snatched, we see price left us a 1-minute order block and a nice fair value gap right here. So honestly, you could take either or, but most of the time it'll be a fair value gap, but either or you're okay with. So if we entered off the order block right here, we'd be risking 1.5 point. Let's say we entered, let's just say we entered right here. Oh snap. Let's say we entered right here, price left this little gap, came down a little bit more, came right back in, and we say we got in right here. Had a little bit of down draw, went straight into profits. So we would have been risking, we could put it at the high right here, risking about 3 points. And like I said, we want to see price head for liquidity on both ends of the markets. So we already just took the buy side liquidity up here, and that's where we're getting our setup from. So we're entering a sell based on it snatching buy side liquidity first. So we snatch buy side liquidity. Now we want to aim for this sell side liquidity right here. So as you can see, this is a wonderful almost 1 to 6 risk reward ratio. Price easily comes down and just smacks straight to your TP, and that's a wonderful setup, hands down. So